This is John Grover. It's September 11th. Doing a quick market update for this month, a little bit late as I have been. But of course, we're watching the development of the rally ending in the stock markets, and I think that they are proceeding to do what they need to be doing. The Dow in particular is weaker than all the others. If you notice here, it has not made a new high since January, and therefore it is weaker because the S&P and NASDAQ have made a new high. Notice this diverging indicator, which is just beginning to show weakness. It's beginning to fail under this pink moving average on the indicator. The lower indicator also, which is very similar in character, shows a similar type of effect. Looking at the NASDAQ, it has hit a target at a new high. It also is diverging, though it is not failing under the pink moving average on the indicator. Once again, we're very close to a top in all of these markets. It would be very wise to begin taking profits or only have an allocation of 50% or so as this market approaches a final top. You can see here in the S&P it's exactly the same situation. It's met its measured move target or very close to it, just a few more points to go, and it has had a rally of almost 18% from the low, which is right in the middle of the average of where we would expect the rally to end. One thing to look at is that this has been a nice strong leg. I expect at least a pullback and maybe an attempt to rally back up, but ultimately one of these setups will fail. So somewhere like this and then a rally back up may occur soon. Maybe not to the end of the year, but it will pay to be prepared for that. Now that we've seen the three stock market indices in the monthly charts, let's look at our normal weekly charts. The S&P, we expected a rally, and we got one this month. It's into this next layer of resistance expected, and it has begun pulling back into the old high after hitting that resistance. I expect it to fall back a little bit further perhaps, and then maybe make another attempt at getting this 2971 level in the cash index. Indicators are supportive here, but just be aware that they're definitely showing that divergence that we were looking for into the real-time, full-time top that we're expecting. After that top, this entire market from 2009 may be retraced. That's probably a bit extreme to call for currently, but needless to say, a large, greater than 20% pullback is expected in 2019, probably. Just as a comparison, and I don't know if you know about divergences, but the indicators are diverging, but look at the German stock market, for instance. It has come nowhere near its high, and in fact is weaker over these last few weeks. The Nikkei is holding up a little bit stronger than the DAX, which is the German index, but barely. It is chopping along and showing its peak as well. So back to the S&P, we'll look real quickly at bonds. Bonds did give us a little bit of a rally last month up to this point, and now they're falling back down. As I said last month, don't expect much from bonds. I believe that they are going to chop back and forth for a little while, but ultimately will fall lower than this 141.10 in the 30-year bond, which means higher interest rates near term. Looking at gold, we had a pretty steep fall early in the month, followed by a rally, which basically comprises that bounce I was looking for. I do expect a decline into this 1134 level sometime soon. That's it for this month, and hopefully you like this, and we'll see you next month. Thank you.